What's going on, Moon Gang? Welcome back to another Dumb Money Update, where of course we're here to talk about what in the world is going on with both AMC and GME. But in this particular update video, I really want to hone in on some of Gary Gensler, the chairman of the SEC, some of his recent comments, especially as they relate to payment for order flow, because I think you're really going to like what you're about to hear. So with that being said, let's hop right into it. For today, Tuesday, September 14th, AMC closed out the day in the red at 47.30 and GME was also in the red at 199.24. Before we hop into the technicals and the Ortex numbers and the flow and all that, I really do want to make the main point of this video, what is going on with Gary Gensler. He did testify today and a couple interesting things came out. One, and I'll start off with this, absolutely pure comedy. He was referred to as Daddy. You heard that right. Gary Gensler, the chairman of the SEC, was referred to as Daddy in a government hearing. Absolutely bonkers. And what was actually even a little bit more, maybe more, maybe less, depending on how you feel about this. But listen to this clip very quickly. Shout out to Ryan Rigg for posting this clip.
I had talked about doing a report sometime this summer and putting a report out, if I remember correctly. Can you talk a little bit about where you are and your concerns with gamification and how it impacts investors?
So three things. One, on the GameStop report, we are pretty close. It's in front of my fellow commissioners, and I would assume it will be out shortly. On I
had talked about doing a report.
All right, just restarted there. So anyway, not feeling the best about that. When he referred to it as the GameStop report, and he had that chuckle, makes me feel as if it's not, I don't know, maybe not a legitimate report. Maybe we're not going to get the information as the retail trading public like that we kind of deserve about how this all played out and what's going on and why was there a massive spike in fails to deliver. So right there, the little chuckle, the report as if like it's a fake report, like it's not a legitimate report. So unfortunately with GameStop, would not hold my breath on that. Would not hold my breath on some big secret being unveiled by the report right there. I mean, a little bit disheartening, but what is, I would say, more positive, and we were listening to this on the stream today, is some of his comments that we've been seeing about payment for order flow. And to make myself very, very specifically clear, we are at a time period where the only people who argue for payment for order flow are the people who are making money on it. I'm talking Citadel Securities, I'm talking Virtu, and I'm talking the politicians who are in their pocket. Anyone who is arguing about the positive nature of payment for order flow, maybe they're a news reporter that has a single-digit IQ, or maybe they're intentionally being intellectually dishonest. And actually, before we get into the comments, I think this is good. So this was from yesterday, September 13th. Gensler reiterates that paying for orders triggers conflicts of interest, basically. And shout out to Dave Lauer. Let's eliminate legalized bribery for order routing. No more kickbacks. Just route orders for the best possible execution and have all small orders executed on exchange. Everyone will win except for retail brokers and the wholesaling duopoly. Obviously, that's Virtu and Citadel Securities. But that's what this is. It is legalized bribery, and the only people who are in favor of legalized bribery are the people who are making money on it. It is not a superior trading mechanism for retail or for anyone. They will argue that you are getting a better, I guess, fill than the NBBO, the National Best Bid and Offer. And actually, Gensler commented on this, that we're using an antiquated measuring rod because that's not good, because really the payment for order flow current system, it didn't ruin the NBBO, but it made it seem worse than it should be if we were all on competitive markets, the best possible execution. Dave Lauer is 100% spot on with his comments right here, and it truly is an intellectually dishonest argument in support of it. Like I said, you're either making money on it or you're a news host that has a single-digit IQ. It is absolutely silly. Do I, at a certain point, appreciate the fact that it brought so many new people into the market and it was the first thing that created commission-free trading? Yes. But you don't just stop at the first thing. Technology improves. For example, Fidelity, Public, both have commission-free trading and they are not using payment for order flow. Obviously, these business tactics have, I guess, in a certain way, they've developed so much that we can still have commission-free trading without payment for order flow. The argument is that simple. Here are the comments from Gary Gensler. I will post this link in the description below because there are extra details in it. I just want to go over the main points. It was written by Brian. Gensler zeroes in on Citadel Securities as SEC considers payment for order flow ban. Wall Street's top cop said Tuesday, today, September 14th, that the dominance of Citadel Securities in the business of routing order flow may not be giving retail investors the best deal. That's exactly what a lot of people have been saying for quite a while. U.S. SEC Commission Chair Gary Gensler told the Senate Banking Committee that he's concerned about Citadel Securities' 47% market share over all U.S. listed retail volume. And right here, that's why it's the duopoly. Virtu comes in around 25 to 30%. Here's what he said. I'm pro-competition, and I'm not sure that payment for order flow system really is the best competitive landscape. We obviously know it's not. The SEC has not ruled out the possibility of a full ban on payment for order flow. One more time for the people in the back. The SEC has not ruled out the possibility of full ban on payment for order flow. Once again, Mr. Gensler said, I think the inherent conflicts of payment for order flow and rebates on the stock exchange both may make our markets less efficient. So right there, he is tasked with protecting the markets, the integrity of the markets, and making them as efficient as possible. And he's identifying payment for order flow as something that makes the market less efficient. And on top of that, we also have previous comments of where he is saying that it does prompt potentially conflicts of interest. So very, very interesting. And this is something that the ape community has been talking about now for a couple months of, hey, PFOF, maybe not the best thing for us. There is a reason that it's banned in the UK and Canada. Please remember that. So let's move on and let's talk about some of the market and AMC and GME specifically. Before we get into AMC and GME, which did have red days, please keep in mind that recently the S&P 500, it fell off today. The NASDAQ 100, it sold off today. The Russell 2000, it sold off today. Three of the major industries, the SPY, the Qs, and IWM, have not only dropped today, but they've been going down for about the past week and a half. And contradictory to that, yeah, AMC didn't have the best day. GME did not have the best day. But over the past week, actually doing pretty fine. And I know this causes a lot of emotional response, and I'm not telling you wrong. I'm just saying, let's be a little calm, cool, collected about the situation and appreciate that, yes, AMC did drop today, but don't forget that until that drop happened today of 8.5%, it was up 68%. And in terms of GME, we are up a pretty nice before this drop off today, which really GME didn't drop that much today. It was up 33%. Today it dropped 2%. So please, when in doubt, zoom out. There's a reason why we're saying this, because the stock market does have a natural ebb and flow cycle to it. So you're not going to get every day green, green, green. Do I want that? Of course. But I'm also trying to be a little bit realistic of the natural movement of a stock. So anyway, back to AMC. It yesterday got rejected at 53. Today it broke below 50 and we're hanging out at 47.50-ish. I'm looking for support to be found here. We have some previous resistance. We have some previous consolidation. Good shot of finding support here. We do have a notable support level at 45, and below that we have support at 42.50. Looking for AMC to catch itself at any of those levels and start to pull a U-turn. I then want it to recapture 50 on volume, which I should point out, crazy low volume today. 65 million shares traded. So this sell-off was, I would describe it as a very weak sell-off. I mean, it's just not many people were participating, not only in AMC, but the market at large today. Low volume today, low conviction. This could easily get erased as soon as tomorrow. Low volume. I'm looking for it to catch itself at support and then rip through 50, 53, and then after that, I will be watching 59. In terms of Ortex, there was a net return of 3.7 million shares today and a borrow of 2.9 million. Now, does that make sense? Does it make sense that 6.6 million shares could have been returned? And in all reality, yes. 2 days ago, and also if you look at September 9th, but we'll focus on the 10th, that was a break of 50. I think there's a legitimate shot that some of the weaker shorts who never thought it was going to get above 50, as soon as it went above it, they cut their risk, they covered their position. 6 million out of 120 million shares on loan. It's not a drop in the bucket, but kind of close to it. I think it's pretty feasible that as we went above that key technical level at 50, that some of the shorts did throw in their towel and they're like, we're done with this. We want to be done with this. And they're no longer involved with AMC. Moving on, utilization 90.47%, and the shares on loan, taking this into account, probably around 109 million, and the short interest clocking in currently at 19.26%. The average duration of these shares on loan recently took a nice jump up to almost 64 days, so they've been paying this cost to borrow fee, which does change day to day for almost in fact, definitely over 2 months now. In terms of the flow, this does kind of explain what we were seeing in the market. I mean, the flow was dominated by the bears, 53% in favor of the bears and 47% in favor of the bulls. So today, the options flow clearly favoring the people who maybe are not the biggest fans of AMC. In terms of GME, GME held its own. Everything in the market was red, and yes, GME was in the red, but it held on. We're hanging out right at that $200 level, key psychological level. Obviously, it's acting as a magnet, both technically and from a psychological perspective. I think it's pretty reasonable that GME is adhering to this. I like that strength, and I just want to see it keep punching upward. I would love to see the break above 28.5, and then from there, about the 212 to 215 area roughly, and then from there I'm watching 215. We do have support between 190 and 188, but GME holding up on its own, I think that's pretty impressive. In terms of its Ortex, there was a net borrow against it on a borrow share count of 179,000. Short interest slowly but surely moving upwards. It's now at 13.75% on a utilization of 36%, and shares on loan around 7.5 million. Recently, we did see a decline in the average age of these shares on loan. It has gone from 41 down to 34, but that makes sense because with the recent increase, that's indicative of the fact that there's new shorts, and with new shorts, that inherently brings down the average age of these shares on loan because they're new shorts. So all that does track, just so everyone knows. And in terms of the flow, we could check that out. Right here, once again, not as stark as AMC, but the flow, the options flow did favor the bears in GME. We have a 52% versus a 48%, just so you know. So overall, would love to get your thoughts on AMC and GME in a comment below. Please, please, please remain calm, cool, collected. One green day does not make us. One red day will not break us. When in doubt, zoom out. We're saying that. It's just not a saying. It is very, very important to realize how much we're up. Don't let one little red day shake your confidence in the situation. But more importantly, at least for today, I mean, it was kind of a boring day in the market, but not so much in terms of the SEC, especially as it relates to Gensler and payment for order flow. Would love to get your thoughts on, do you think he's just talking to talk, or do you think he truly has our back and is looking to fix some of the broken aspects of our market? Once again, let me know in a comment below. And until I catch you next time, from me and Chair, best of luck in the markets.